Welcome back, everyone. Ready for another deep dive?
Absolutely.
Awesome. Today, we're tackling International Accounting Standard 1, or IAS 1 for short.
IAS 1.
Yep. We're going to try to make it your cheat sheet to understanding financial statements.
Ah, okay.
They're basically how businesses talk to us.
The language of business.
Exactly. And we're going to be using excerpts from this document we have.
It's pretty dense.
Yeah, it is pretty dense, but don't worry, we'll break it down.
Okay.
We're going to make sure you walk away understanding the essentials of IAS 1.
Sounds good.
Especially if you're involved with publicly accountable companies or businesses on the stock exchange.
Right. Public companies, stock exchanges.
This is really the foundation for how they report their financials.
Yeah. Make sure everyone's on the same page.
Exactly. And we'll be uncovering all sorts of interesting stuff like the going concern concept, accrual accounting. We'll try to point out all those aha moments and give you some practical takeaways along the way.
Right. So let's demystify these financial statements.
Yeah. First things first, though. Why should anyone even care about IAS 1? What makes it so important?
Well, imagine you're an investor and you're trying to compare two companies. Maybe one's in London, the other's in Tokyo.
Okay. Different countries, different markets.
Exactly. And without a common set of standards, their financial statements might look totally different.
Ah, yeah. Apples and oranges.
Exactly. It'd be almost impossible to compare their performance.
Hmm.
IAS 1 levels the playing field, though.
How so?
It creates a common language for businesses all around the world.
So it's like everyone's speaking the same language.
Exactly. It's like having a universal translator for business.
Ah, I like that. A universal translator. So this makes life easier for investors who are trying to figure out where to put their money.
Exactly. Investors, creditors, anyone who needs to assess a company's financial health.
Makes sense. So how does IAS 1 actually work? Where do we even begin?
Well, it all starts with the objectives.
Okay, objectives first.
IAS 1 has 4 key goals for financial reporting: completeness, comparability, understandability, and relevance and reliability.
All right, 4 big ones. Let's break those down a little bit. What does completeness actually mean?
Well, completeness means that the financial statements should provide a full and accurate picture of a company's financial position.
Okay, full disclosure.
Full disclosure, no hiding skeletons in the closet.
Got it. So no funny business.
Yeah.
Everything needs to be out in the open. How about comparability? We touched on that earlier, but what's the real impact for someone looking at these reports?
Well, comparability means that you should be able to easily compare financial statements
Okay.
between different companies
All right.
and across different reporting periods.
I see. So I can compare apples to apples.
Exactly. That's
Yeah.
what we want. So you can directly compare the performance of a company listed on, say, the Frankfurt Stock Exchange to one listed on the Tokyo Stock Exchange.
Ah, okay. Makes sense. So like they're all using the same measuring stick.
Yep. Makes it much easier to see who's performing better.
Okay, so we've got complete information and we can compare them. But how does IAS 1 make sure these reports are understandable?
Well, it tries to ensure that financial statements are presented clearly,
Okay.
concisely, and avoid unnecessary jargon.
Right, so you don't need to be a CPA to understand it.
Exactly. Anyone should be able to grasp the basics.
Okay, and what about relevance and reliability? Those sound important.
They are. It means the information in the statements is actually useful,
Okay.
and it can be trusted.
Useful, trustworthy.
The numbers need to be accurate and free from bias. They should give a faithful representation of the company's financial reality.
Okay, so no creative accounting allowed.
Absolutely not. It's all about a true and fair view.
But true and fair view. I
Yeah.
like that. So we've got our objectives. What are the actual pieces of these financial statements? What are we actually looking at?
Well, IAS 1 outlines 5 main components. There's the statement of financial position, which is also known as the balance sheet,
Okay, balance sheet.
statement of profit or loss, and other comprehensive income.
Profit or loss.
Yep. Statement of changes in equity,
Changes in equity, got it.
statement of cash flows,
Okay.
and of course the notes to the financial statements.
Ah, yes, the notes. 5 major pieces of the puzzle. So let's start putting that puzzle together. What does the balance sheet tell us?
It's basically a snapshot
Okay.
of a company's financial health at a specific point in time.
One point in time.
It shows what the company owns, which are its assets,
Assets.
what it owes to others, its liabilities,
Liabilities.
and the difference between those two, which is the owner's equity.
Okay, so it's kind of like checking your own personal net worth, but for a company.
That's a great way to think about it. You see what the company's worth once you've accounted for any debts.
All right, makes sense. What about the statement of profit or loss? That one sounds a bit more dynamic.
Yeah, this statement, often called the income statement, Tells you the company's financial performance over a period of time, like a quarter or a year.
Okay, over time.
Shows you how much revenue they generated,
Mm-hmm.
how much they spent on expenses,
Okay, revenue and expenses.
and whether they made a profit or loss.
So it's like tracking the money coming in and going out and seeing if they ended up in the black or the red.
Exactly. And the other comprehensive income part captures gains and losses that might be a bit outside their normal business operations.
Okay, a little more unusual.
Right.
All right, the next one sounds pretty straightforward. Statement of changes in equity. Is it as simple as it sounds?
It really is.
Yeah.
It tracks how the owner's stake in the company has changed
Okay.
over time.
Over time.
Did they invest more money? Did the company make a profit, increasing their stake? Did they pay dividends? This statement has those details.
So it's like seeing how the ownership pie is sliced up and how those slices change over time.
Perfect analogy.
Mm,
You can see how the value of their ownership is affected by company performance and their decisions.
got it. All right, what about the statement of cash flows? This one always seemed a bit mysterious to me.
Well, think of it like this. It's a detailed look at the company's bank account.
Okay, their bank account.
It tracks the cash going in and out,
Got it.
and it breaks it down into operating activities,
Okay.
investing activities, and financing activities.
3 categories. So operating activities, is that like the day-to-day stuff?
Right. Money from sales coming in, money going out to pay salaries and buy supplies.
Got it. And investing activities would be like buying or selling big things.
Exactly. Property,
Yeah.
equipment, maybe even other companies.
I see. And then financing, that's got to be stuff like taking out loans or paying dividends.
You got it. It shows you where the company's cash is coming from and where it's going.
So it can tell you a lot more than just looking at profit and loss.
Definitely.
Yeah.
You can see if they're actually generating enough cash to cover their bills and investments.
Okay, super helpful. And then we can't forget about those notes to the financial statements. What's the deal with those?
The notes. They're super important.
Yeah.
They give you context and details you won't find in the main statements.
So kind of like the fine print.
Exactly. They flesh out the story behind the numbers.
Yeah.
Explain the company's accounting policies, maybe some significant judgments or estimates they made, and any unusual transactions.
So if the financial statements are the main course, the notes are like all the little side dishes and condiments that make it a full meal.
Perfect analogy. They add all the flavor and depth.
They bring it to life. Like a company might disclose their revenue recognition policy, right?
Exactly. And that can vary depending on the industry.
I see.
Or maybe they'll explain a big lawsuit that could really impact their financials.
Wait, so if a company's being sued, their financials could look totally different depending on how they estimate the outcome. That seems like a lot of room for interpretation.
It can be. That's why the notes are crucial. You see the assumptions and judgments they made.
Ah,
It helps you decide just how reliable those numbers really are.
I see. The notes sound a lot more interesting than I initially thought. So we've covered the objectives and all the major parts of financial statements. Now let's get into the nitty-gritty.
All right, the rule.
The rules and features that companies have to follow. This is where IAS 1 gets really specific, right?
It does. It's all about providing a framework for consistency and comparability.
Consistency, comparability. We keep coming back to those.
They're essential.
Got it. So let's start with the going concern basis.
Okay. Going concern.
That's a fundamental assumption.
Yeah, one of the most important in accounting.
Okay. I'm intrigued, but also a little worried by the name. Going concern. What exactly does that mean?
It's not as scary as it sounds.
Okay.
It basically assumes a company will keep operating in the foreseeable future.
So we're assuming they're not about to go bankrupt.
Exactly. Unless there's some strong evidence suggesting otherwise.
So an optimistic outlook, but not just blind faith.
Right. Auditors and analysts look at their financial performance, their industry, any potential risks.
So if a company has been losing money, has a ton of debt, and is in a shrinking industry, that's not a good sign.
No, not at all. The going concern assumption might be a bit shaky in that situation.
Yeah. I see. So their financials might need to be prepared differently,
They might.
and investors would need to be really careful.
Exactly.
Okay. Makes sense. You wouldn't value a used car the same way if you knew it was about to fall apart.
Exactly.
All right, up next, we've got the accrual basis of accounting. This one takes me back to accounting class.
Back to school.
Yeah, I could definitely use a refresher on this one.
Okay, so the accrual basis basically means companies recognize revenues and expenses when they are earned or incurred,
Okay.
regardless of when cash actually changes hands.
So it's not just about tracking the dollars in and out of the bank account?
Right. It's more about matching revenues and expenses to the period they relate to,
Okay.
even if the cash flow happens later.
Even if the cash flow happens later. So give me a real-world example.
Sure. Imagine a software company that sells a subscription in December.
Okay, December.
Customer pays upfront for a whole year,
Whole year upfront,
but the company can't just recognize all that revenue in December,
even though they have the cash.
even though they have the cash. Yep.
Okay.
They have to spread it out over the whole year as they provide that service.
Ah, that makes sense. They're recognizing the revenue as they earn it.
Precisely.
Got it. What other key features should we know about?
Well, there's consistency of presentation. Companies have to be consistent in how they present their statements.
Okay.
Consistent
That's
over
period to the
time,
next,
right.
one period to the next. So if they change how they categorize expenses, that could make it hard to track their performance over time.
Absolutely. Consistency helps you spot trends and compare performance so you can make good decisions.
Got it. Consistency definitely makes things easier. What else is there?
Okay, let's talk about materiality and aggregation.
Those sound a little technical. Break it down for me.
Okay, so materiality essentially means companies only need to report information that is significant enough to actually matter.
Okay, so if a company buys a $5 stapler, they don't need to list that out on their financial statement.
Exactly. That wouldn't really impact their overall financial picture.
Right, that makes sense. And how does aggregation tie into that?
Aggregation is about grouping similar items together
Okay,
to make the statements shorter and easier to read.
I see.
Like instead of listing every single office supply purchase separately, you might just have one line for office expenses.
Makes sense. Less clutter, more clarity.
Exactly.
Okay, what else should we know about?
Well, IAS-1 generally prohibits offsetting,
Offsetting.
meaning a company can't just net their assets against liabilities or income against expenses.
Why not? Wouldn't that make things simpler?
Well, it can actually hide important information. Like imagine a company has a lot of cash, but also a lot of debt.
Okay, lots of cash, but also lots of debt.
They might be tempted to offset those and just show the net difference, but
But that wouldn't show the whole picture.
exactly. IAS-1 wants to make sure everything is transparent.
Okay, so investors and creditors can really understand what's going on.
Exactly.
No hiding behind fancy accounting. What's our last feature for today?
The last one's comparative information.
Okay, comparative. What's that?
Companies need to present data for the current period and the previous period side by side.
So it's like a before and after picture of their financials.
Exactly.
Yeah,
You can easily see how their financial position and performance have changed over time.
I see. Helps you spot trends.
Exactly.
Okay, that makes sense. So we've got the objectives, the components, and all the key features of IAS-1. But what about the actual layout of these statements? Are there rules about that too?
There are. IAS-1 gives guidance on the structure and content.
So it's like setting the ground rules for how these statements should look and feel.
Precisely. For example, every statement needs a clear title. You got to display the company's name.
Got it.
The dates covered should be obvious, and you have to say what currency you're using.
So no more deciphering statements that look like they're in different languages?
Right. It's all about a standardized format that anyone can understand.
Okay, I'm seeing a theme here. Clarity and transparency seems super important for IAS-1.
Absolutely. It's all about making sure that information is accessible, reliable, and comparable.
All right, we've talked a lot about the numbers themselves, but what about other information companies have to give along with those numbers?
You're talking about disclosures.
Disclosures?
Yeah.
Right.
They're a crucial part of IAS-1.
Oh,
They give you that context that goes beyond the numbers in the statements.
so what needs to be disclosed? What are we talking about here?
Well, one of the most important is their accounting policies,
Why are those so important?
because those policies can really impact how a company's performance looks.
Okay.
Like how they decide to value their inventory or depreciate their assets, that can change how much profit they report.
Ah, so you have to know those policies to really understand what the numbers mean.
Exactly. Like you need to have rules of the game to understand the score.
I like that. What else needs to be disclosed?
Well, they also had to disclose any significant judgments or estimates they made.
Okay, judgments and estimates.
These are the areas where their decisions come into play.
Got it. Can you give me an example?
Sure. Let's say a company is facing a lawsuit.
Okay, lawsuit.
They have to estimate how much they might have to pay out.
Right. That's tough to predict.
It is, and that estimate could really affect their financial position.
Ah, I see. So disclosing these things helps you understand the risks involved.
Exactly. Adds another layer of transparency, so investors and creditors can judge the reliability of those numbers.
Okay, yeah. It's not just the numbers themselves. It's about everything behind the numbers.
Exactly. And IAS 1 actually encourages companies to go even further.
Okay.
They want them to disclose information about the risks they face, like credit risk, liquidity risk, market risk, things like that.
Risks. Why is it important to disclose that?
Well, it gives you insight into the potential challenges they might face, how prepared they are.
Okay, so it's kind of like a peek behind the curtain at how they're managing those risks.
Precisely. The more you understand the risks, the better decisions you can make.
Okay, I think I'm getting a much better grasp on all of this. IAS 1 really wants to paint a complete and transparent picture.
It does. Clear, consistent, comparable, and reliable.
Well, I have to say, I feel a lot more confident about understanding financial statements now.
That's fantastic.
Okay.
Remember, this isn't just for accountants.
Right.
It's for everyone who wants to understand the financial world, whether you're an investor, a creditor, or just a curious person.
Well said. But this is just the beginning. We'll be back with part 2 to see how these IAS 1 principles play out in the real world.
We'll see how these concepts actually impact your decisions. Stay tuned.
We'll be right back. We're back and ready to dig even deeper into IAS 1.
Deeper into IAS 1.
We've got the foundation.
Yep.
But now I really want to see how these principles actually work in the real world.
The real world.
Yeah. Got any interesting examples?
Oh, absolutely. Let's say you're comparing two companies in the same industry.
Okay, same industry.
One's based in Germany, the other's in South Korea,
Germany, South Korea.
both making electric vehicles.
Got it. Electric vehicles, hot industry.
But their financial statements look completely different.
Ah, okay. I'm picturing it. Different currencies, different layouts.
Yeah, it can be overwhelming.
How can an investor even begin to make sense of that?
That's where IAS 1 really helps you out.
How so?
Because thanks to IAS 1, both of these companies, even though they're in different countries, different markets, they got to follow the same basic set of rules.
The same structure, the same principles.
Exactly. So even though they're coming from different places, their statements will have that uniformity.
So I can actually compare them.
You can. Apples to apples.
I love that. Apples to apples. So I can look at their revenue growth,
You got it.
profitability, debt levels,
Yeah.
all on a level playing field.
Exactly. It makes it so much easier for you to see who's actually healthier financially.
That is a game changer. No more struggling with currencies and different accounting languages.
Exactly. That's the power of IAS 1.
Okay, I'm sold on comparability. Now I want to go back to something we talked about before, the going concern assumption.
Okay, going concern.
How can an investor really know if a company is truly a going concern? Are there any warning signs?
It's a good question.
Yeah,
And it's one that keeps analysts and auditors up at night.
up at night.
There are definitely some red
What
flags.
are red flags?
Think about recurring losses, a big pile of debt that's got to be paid soon, legal problems that could mess up their operations.
Okay, so these are all things that could make a company less likely to stay in business.
Exactly. They could cast some serious doubt on that going concern assumption.
So I can't just assume everything's fine. I actually have to look for those red flags.
You do. Auditors and analysts are always looking for proof that this assumption is valid.
Okay.
And if they're not so sure, they might issue what's called a qualified opinion.
Qualified opinion, that sounds serious.
It is. It's basically a warning to investors that something might be wrong.
Okay, so if I see that, that's my cue to proceed with caution.
Big time. Do your homework before you invest.
Got it. Always read the fine print. Let's move on to another important concept, the accrual basis of accounting.
Okay, accrual basis, a classic.
Yeah. Can you give me an example of how that actually affects a company's performance in the real world?
Sure. Imagine a construction company.
Okay.
They win a huge contract to build a giant skyscraper.
Skyscraper, wow.
This is going to take years to complete, but they get a big chunk of the payment up front.
Okay, big payment up front, but the project takes years,
Now, with the accrual basis, they can't just count all that money as revenue right away.
even though they have the cash.
Even though they have the cash in hand, they can't do that.
Okay.
They've got to spread that revenue out over the whole life of the project.
Spread it out as the project progresses.
Exactly. So it matches the revenue to when the work's actually getting done.
Ah, that makes more sense. So their financials show a more gradual increase in revenue.
Precisely. It paints a more accurate picture.
Makes it less lumpy.
Exactly. Less lump.
Okay, I'm starting to see how these accounting rules actually affect how we view a company's performance.
It's not just about the numbers themselves. It's about all the nuance behind them.
Right, and the accrual basis helps us see that nuance.
Exactly. And that's why understanding the reasoning behind IAS 1 is so important.
It's more about the why than just memorizing rules.
Right. grasp those principles, and you understand how we get to more transparent and reliable financial reporting.
Well said. Okay, let's talk more about those disclosures.
Okay, disclosures.
Can you give me an example of a disclosure that might be really important for an investor, something that you wouldn't necessarily see just from the basic numbers?
Sure. Let's say a company depends heavily on one specific supplier
Okay, one supplier.
for a really important part of their product.
Okay.
Maybe they only have this one supplier because what they need is very specialized.
So if that supplier has a problem, the company's in trouble.
Big trouble. IAS 1 encourages companies to talk about this kind of dependence in their notes.
So if I'm reading those notes, I might realize this company is vulnerable because they're relying too much on this one supplier.
You got it. That's the kind of insight you can get from disclosures.
Fascinating. It's like peeking behind the curtain to see what could go wrong.
Exactly. Helps you make more informed decisions.
I'm really starting to appreciate how important it is to understand IAS 1. It's not just for accountants, it's for everyone who wants to be a better investor.
It is. It's for anyone who wants to understand how the world of finance really works.
Well said. But we're not done yet. In part 3, we'll be looking into the future.
The future of IAS 1.
How is it changing? How will it keep up with this crazy global economy?
It's going to be fascinating. We'll be right back.
We're back for the final part of our IAS 1 deep dive.
The grand finale.
Exactly. We've covered the basics, seen how it works in real life, and now, well,
Now it's time to look ahead.
time to look ahead.
What's the future of IAS 1?
Yeah, the future. What's coming down the pipeline for this important accounting standard?
Well, the business world never stops changing, does it?
Never.
And accounting standards, they've got to keep pace.
They can't just stay the same.
Exactly. So what big trends are we seeing?
Yeah, what's shaping the future of IAS 1?
One of the biggest trends, it's got to be sustainability.
Sustainability. Everyone's talking about that these days.
For good reason.
Right. Investors, the public, they want to know about a company's impact.
Not just on profits.
Right, but on the environment, on society, the whole ESG thing.
ESG, exactly.
And is IAS 1 keeping up with this?
It's trying to. It's encouraging companies to include ESG information in their reports.
Wow, that's a big change. So are we going to start seeing a company's carbon emissions right there next to their profit?
It's possible. You can
Cool.
see employee diversity stats, water usage, all kinds of things.
That's amazing. It gives you a much bigger picture.
It does. It shows you how sustainable a company really is.
Sustainability. Okay, what else is on the horizon for IAS 1?
Well, we can't ignore technology.
Technology, right. Everything's going digital.
Blockchain, AI, big data, all of this is changing how business works.
And accounting has to keep up.
Exactly. Think about it. You could use AI to analyze huge amounts of data,
Yeah.
spot patterns that would take humans forever.
That's incredible. What about blockchain, though? How does that fit in?
Well, think about it. All transactions recorded on a blockchain.
Okay.
Secure, permanent, can't be changed.
So everything's out in the open?
Everything's transparent.
Yeah.
It could totally change auditing.
Wow, that's a huge leap forward. But with all these changes, how can we make sure IAS 1 stays relevant, stays effective?
That's the challenge, isn't it?
It is.
But the International Accounting Standards Board, or the IASB,
Okay.
they're the ones who develop IAS 1, and they're always watching,
You're keeping an eye on things.
talking to businesses, investors, regulators.
So they're not just making decisions in a vacuum?
No way. They're getting input from all over the world.
That's good to hear. So they're constantly working to make sure IAS 1 is up to date.
Exactly.
Yeah.
That's what keeps IAS 1 strong.
All right, as we wrap up this deep dive, what's the one thing you want our listeners to remember about IAS 1?
I want them to remember that it's not just a bunch of rules.
Okay.
It's really a framework for clear communication,
Clear communication.
making sure financial reporting is consistent,
Oh.
comparable, reliable.
So anyone can understand what's going on with a company.
Exactly. Whether they're investors, creditors, anyone.
So it empowers people to make good decisions.
It does. And the best part?
What's that?
It's always evolving
Always evolving.
to keep up with our crazy world.
I love that. IAS 1, it's not static, it's alive.
Hmm.
Well, a huge thank you to our expert for taking us on this incredible journey through IAS 1.
It was my pleasure.
And to our listeners, we hope you learned a lot today. We'll see you next time for another deep dive into the fascinating world of business and finance.